Hello friends. Welcome to the TradeAbility channel. In this video we're going to talk about one of the most important aspects of trading. Probabilities and expectancies. Everyone who is trading currencies, stock market, cryptocurrencies, or any other financial derivative should know about probability and expectancy. In fact, it's so important, I do not recommend anyone to start trading without knowing the fundamentals of this subject. By the end of this video, you will learn about what probability and expectancy is in trading, how it's calculated, and how to use it in your trading strategies. Most importantly, we are going to answer the question that everyone is itching to find out. Do you really need a 2-to-1 reward to risk ratio to be a profitable trader? Or is it just a myth? You'll find out the exact answer in this video. The answer will surprise you. But before we get started, if you find this video and channel to be useful, hit the like button, subscribe, and hit the notification bell so you always know when we release a new episode. Now, without further ado, let's get started. What is probability in trading? Probability is the key to developing profitable long-term trading strategies. Probabilities is the edge you have in the market, and influences many trading decisions such as lot sizing, setting max risk per trade, and trade frequency. Let me ask you this. If you currently have a trading strategy, do you know your overall probability of winning a trade? If you don't know the answer to that question, then you're most likely not going to have long-term success in trading, unless you're very lucky. Let me ask you another question. How do you feel when you make a streak of losing trades? Do you feel down and defeated? Or do you feel confident that because you know the statistics of your strategy, those losing trades are expected and your trading strategy will quickly recover from the losses? So, what is trading probability? Probability is calculated by dividing total winning trades by total trades. In this example, we have a total of 68 total winning trades out of a total of 100 trades. It means that this trading strategy has a 68% probability. It's important to note that the more trades you have, the more accurate the probability percentage becomes. Now that we covered probability, let's talk about expectancy. Expectancy is the expected profit or loss for a single trade. The formula for expectancy is the following. The probability of winning trades multiplied by the average profit per trade minus the probability of losing trades multiplied by the average loss per trade. The result is the expected profit or loss for every trade you take. If the result is greater than 0, then you have a positive expectancy. If the result is less than 0, then you have a negative expectancy. In order to be profitable, you need to have a positive expectancy. Let's do an example. If a strategy has a win rate of 70% with an average profit of $200, and the loss probability is 30% with an average loss of $150, then the result is a positive expectancy of $95 per trade. It's also noteworthy that in this example, the reward-to-risk ratio is 1.3 to 1, which we will discuss more in detail later in this video. Once we have the expectancy, we can then calculate the total expected long-term profits by multiplying by total number of trades. If your strategy produces 100 trades per year, then your expected profits per year is $9,500. Let's put it all together and discuss how probabilities and expectancies work hand in hand with reward-to-risk ratios. If you've been trading for a while, you might have heard many times that you must have at least a 2-to-1 risk-reward to be a profitable trader. Let's explore this topic further together. Here I have a table that shows the relationship between win probability, reward-to-risk ratio, and its corresponding expectancies. Red represents a negative expectancy and green represents a positive expectancy. Let me explain more in detail of how this table works. In this first column, I have a set of win probabilities. The following columns show the corresponding expectancies related to the reward-to-risk ratio indicated in the column header. Let's look at an example. Let's look at this row here. The 50% win probability row. It shows that in order to have a positive expectancy, the trade strategy needs to consistently have a minimum of 1.5 to 1 reward-to-risk ratio. So, for example, if I have a $10,000 account and risking 1% per trade, which is $100, I would need to seek a minimum profit target of 1.5 times the risk. That is equivalent to $150 in order to be profitable in the long run. If we multiply the expectancy of 0.25 by the total risk, then multiply that by 100 trades, the strategy would expect to net a total profit of $2,500. Now, let's look at the 2-to-1 reward to risk column. It shows that in order to be profitable, the trade strategy only needs to have a 35% probability win rate to be profitable. If the strategy is risking $100 per trade, over 100 trades the strategy can profit only $500. As you can see, it's significantly less than a strategy that has a 50% win rate with a 1.5 reward to risk ratio. However, the potential earnings of the 2-to-1 reward to risk ratio is significantly higher as the win rate increases. With that said, there are a couple of other issues with the 2-to-1 ratio that I would like to discuss. It may get you to change your mind about it being the golden rule in trading. The first problem: the frequency of trades is significantly smaller with trade strategies that use 2-to-1 or higher reward to risk ratios. The reason is traders must wait for high-quality trades in hopes of increasing the probability of the trade to win. Therefore, the number of tradable setups will decrease significantly, which affects the total profits of the strategy. So, instead of having 100 trades per year, they could end up only having 50 trades in a year. The second problem: the drawdown risk is higher in a 2-to-1 reward to risk strategy. Because the win rate of 2-to-1 reward to risk strategy is typically lower, the loss rate is higher, thus increasing the risk of drawdowns. Let's take the win rate of 35%. The reciprocal losing rate is 65%. The probability of 2 losing trades in a row is 65% multiplied by 65%, which is equal to 42%. This means that the probability of having 2 losing trades in a row is greater than having 1 winning trade. The probability of 3 losing trades is 27%, which is less but still a significant probability. The good thing is that a single win will be able to recover 2 losses quickly. However, the problem is with the high probability of drawdowns, the trader must limit their maximum risk. If the loss probability is 65%, the probability of 5 consecutive losses is 11.6%, which means in a set of 50 trades, there will be at least one sequence of 5 trades with consecutive losses. If a trader wants to risk 2% per trade, they would need to be able to endure a drawdown of 10% of their balance, which many traders may find difficult to stomach. So, with the combination of lower frequency of trades and the limit on maximum risk, the profitability of a 2-to-1 reward to risk ratio trading strategy may not be as profitable as it sounds. So, if you have a 2-to-1 strategy that has a 35% win probability, you would probably only limit maximum 0.5% per trade to limit your drawdowns. And instead of trading 100 trades per year, you would probably only get 50 good quality trades. The expected total profit is only $125, which is only a 1.25% gain in total profits after 50 trades. Let's look at the other end of the spectrum. Let's use the 0.75 to 1 ratio. The minimum win probability to have a positive expectancy is 60%. Notice the expectancy is the same as the expectancy for a 2-to-1 ratio at 35% probability. A 0.75 to 1 ratio trade setup will typically have a higher probability because the distance the price has to move to hit the take profit is lower than the distance to the stop loss. Let's look at the drawdown risk probabilities. With a win rate of 60%, the probability of 2 consecutive losses is significantly less than the probability of winning a trade. The probability of losing 5 consecutive trades is only 1%, which means, for every 500 trades, there will only be one set of 5 trades with consecutive losses. Compare that with the 2-to-1 ratio's 35% win rate that expects one set of 5 consecutive losses in 50 trades. This means that with the higher win rate, we do not have to worry about limiting my risk as much, and we can use a higher risk per trade of 2%, for example. Even with a 6% probability of a 3 consecutive losses, or 12% drawdown of the account, the probability of it occurring is only 1 out of every 100 trades. The other benefit of a 0.75 to 1 risk-reward ratio strategy is that the setups are more frequent and you don't need to wait for the perfect quality setup to enter a trade. The probability of winning a trade is high enough to give the trader a higher confidence level, and this is especially beneficial for new traders. It means that we are open to take more trades, even if the setup is not perfect, as long as we stick to the rules of the strategy. So, going back to our account balance of $10,000, With this 0.75 to 1 ratio and a 60% probability, we can increase our risk to 2% per trade. In addition to that, we are free to open more trades, even if it's less than perfect. We'll use 100 trades for this example. The total expected profits by the end of the 100th trade is expected to be $1,000. That's a 10% gain on the account balance. Compare that to the 2 to 1 ratio, that's a significant difference. So, what are the key takeaways from this lesson? Number 1, it doesn't matter how you trade or what strategy you use, you must know the statistics of your strategy. Key statistics you need to know are win probability, expectancy, and frequency of trade. From there, you would determine the best reward to risk ratio that gives you the optimum profitability. Number 2, you do not need to have a 2 to 1 reward to risk ratio in order to be profitable. Finding a strategy that can give you consistently high probability trade and high frequency setups at a 2 to 1 ratio is challenging, but it is achievable. If you want to have a 2 to 1 ratio strategy, I recommend to have a win probability of greater than 50% or more in order to be profitable. Number 3, having a lower reward to risk ratio like 0.5 or 0.75 to 1 is not always a bad thing. We have shown you that statistically, it is easier to become profitable using a high probability and frequency strategy with a lower risk to reward ratio. Typically, scalpers use these kind of risk-reward ratios. Number 4, you should always consider the drawdown risks. The probability of consecutive losses are higher with low win probability ratios such as 2 to 1. It impacts your ability to increase risk per trade and therefore impacts your profitability. Higher probability of consecutive losses is also detrimental to the psychology of the trader. The final recommendation in this lesson is, no matter how you decide to trade, you must find a strategy that works for you and your trading personality and risk profile. You must backtest and fully understand the statistics of your strategy, so you can feel confident that your strategy will have its ups and downs, but in the long run, will be profitable. Well, that's it for this video. I hope you found the information useful. If you did, please remember to like, subscribe and hit the notification bell so we can continue delivering you quality trading videos. See you in the next video.